All right, good afternoon. My name is Josh Doing. I'm the Startup Support Manager at the University of Maryland's Ventures office. I'd like to extend a warm welcome to everybody who's joined us today for our workshop. This workshop is part of the ongoing Startup Fundamentals Workshop series. This series is offered by Ventures with collaboration from the Maryland Technology Enterprise Institute and the Dingman Center for Entrepreneurship at the University of Maryland. We will be recording today's workshop. We try and provide recordings of this workshop on our YouTube channel. And so just be aware that we are recording what's going on. I do have the chat open. And so if you do have questions, please put those in the chat. I will be monitoring the chat and we'll be able to answer those questions as they come up. For today, we're going to be learning about tax considerations for startups with Professor Sam Handwerger. Again, it'll be live. There'll be room for questions. Professor Sam Handwerger prefers to answer the questions as they come up, so please feel free to ask. We do want to make this applicable to you. You can, like I said, it will be recorded and will be available to view afterwards. So if there are slides and things that you want to see, that will be made available afterwards on our YouTube channel, along with previous workshops that we've done as part of this series. Professor Sam Handwerger, CPA, is a senior lecturer in the Accounting and Information Assurance Department and is a University of Maryland undergraduate accounting alumnus. He also holds a Master's of Science in Taxation degree from the University of Baltimore. He was a senior tax researcher with EY in New York City and later led the tax planning and preparation departments of the CPA firm Handwerger, Cardania, Funkhauser, and Lerman. In 1996, he was awarded the Governor's Volunteer of the Year Award in the state of Maryland for financial and management advisement to nonprofit organizations. Before joining the Smith School on a full-time basis, Handwerger held adjunct positions at Johns Hopkins University School of Business and University of Baltimore School of Law. Handwerger's professional accomplishments include giving professional expert testimony in various legal cases involving accounting and tax issues, as well as for the now landmark decision in the Maryland Tax Court Har Sinai West versus Comptroller. Further, in 2013, Handwerger orchestrated a no-change IRS audit in tax court involving a $30 million assessment, docket 28353-12. I'm going to pass the time over to Professor Handwerger. Like I said, I will be here monitoring the chat, but I'm going to go off camera so that you can have your full attention on him. Sam, are you able to share your presentation?
I shall be able to, I believe. I'm all set up. Let me begin to do that. And let's see. Hold on. There we go. Share, and we should be all set.
Great. I can see him.
Okay. All right. Well, thank you, Josh, for the introduction. And thank you all for being here. I should really do the following before we begin. And that would be if you are, let's do it this way, by the reaction, raising hands, if you could let me know how many of you are, we have a small crowd here, even though we're recording, are you actually in a startup today or contemplating one in the near future? Well, you can actually unmute your mic if you feel comfortable.
So I think I'm the only one who can grant people speaking access.
Oh,
but I'm seeing three hands up here, Lynn, William.
Okay. I don't see I don't have my view one for that. Okay, great.
Jim
So they're
Moon.
all in. Okay, excellent. So here's what you do. Feel free to ask questions as we go along, even if they're just pertinent to you. It's okay. It's probably pertinent to somebody else. Fair enough? All right, here we go. Let's get back to business. All right, tax considerations for startups. Here we go. The agenda is the loose agenda, I should say, is we're going to look at the entity structure, sales tax, because you'll see when we get there how important it is for us to cover it, employment tax issues. We'll breeze through some common pitfalls. We'll skip the year-end planning since it's now February, and then we're going to go back to business deductions towards the end. So if you're interested in what's deductible to lower your tax, we're getting there. All right, so let's get right rolling. All right, the entity structure matters, obviously, because if you choose the wrong one, it might become expensive to fix later. So we're going to give you a structure here of how the entities work, and then I'm going to give you some practical advice if you're a startup, like a small startup, you're trying something out. where to begin with your entity structure and how to figure out where it might be going. All right, on that note, let's see what we got. All right. Four main options: sole proprietorship, otherwise called could be a single member limited liability company. We'll discuss why. There's a partnership, there's a multi-member LLC. These are all put into a specific box because they're going to be treated similarly. These will be as if they're one group. And then there's a C corporation, which means basically a regular corporation for tax purposes. And then something called a S corporation, so named for subchapter S, where it falls in the Internal Revenue Code, but many people assume it means small business corporation, which is just as well because it works for a small business. All right, sole proprietorship, single member LLC. Here's the deal. First, we're going to talk about liability, and then we'll talk about how it gets taxed. Liability means who's responsible for the debts of the business in the event that the business ends with debts. So if you're a single member limited liability company and the creditors to your business are giving you credit, giving you loans, giving you that ability to use their money instead of paying up front, like a rental agreement, and they write the agreement in the name of the limited liability company, then that means that you are not personally at risk for those debts. Unless they ask you to sign a personal guarantee, you would not be personally liable for the debts. Why is this important? Well, it's not so important for your normal business operations, but it's more important in case a mistake is made in your limited liability company, your business. If you make a mistake that might lead to a lawsuit of some sort, and you're not a professional where you have to pay up for your malpractice, like lawyers, dentists, accountants, doctors. If you're not in that particular professional structure, then the single member LLC gives you, as the name says, limited liability protection for suits of that nature. So the first order of business is we'll start with giving you the advice that if you begin a small business enterprise and you're just trying it out, you could go for a month or two as a regular sole proprietorship without going to the trouble of creating a limited liability company for yourself. However, after a while, if it looks like it's going to take off, I would definitely recommend going to the limited liability company on the threshold or theory that you get that limited liability protection. Important to have. And by the way, it's almost ridiculously cheap and inexpensive to create a limited liability company. Here in Maryland, it's about $120. It's about 5 minutes online to do it, and then you just got to get an EIN number from the IRS. That's another 2 or 3 minutes. So within 10 minutes time, you can give birth to your own limited liability company, and you're off and running. So if you do that to start, and even if you're just trying it out, no harm done. The limited liability company is taxed just like a sole proprietorship. And this is why it's a little strange. So just bear with me for a second. Under the tax law, the way the IRS treats a limited liability company when there's only one member, owners of limited liability companies are called members. So if there's only one member, one owner of that LLC, it's ignored for tax purposes. It's still there to protect you from liability, but for tax, it's as if it didn't exist. So you get taxed as a sole proprietorship. Since it doesn't exist and you're the only owner, that's what you are, a sole proprietorship, which is fine. It doesn't hurt you. This is what taxation means for a sole proprietorship. You report it on your individual tax return, Schedule C, no separate filing. You will pay self-employment tax, 15.3% on all profits. That's a little bit of a issue. We're going to talk about that momentarily, but there's no separate business tax. Let's talk about this 15.3% and just get an idea of what that all means. All right, here we go. So when you work for somebody, you pay 7.65% in Social Security and Medicare. They take it out of your paycheck. The employer, so we'll call this the employee. We'll do a couple E's at the end. The employer, getting real creative here with an R, they also match that same 7.65% for the same tax. So the employer pays half, you pay half, and you can see that there you go, the total is 15.3. When you're your own boss, which is what sole proprietorship really means. You work for yourself. You're your own boss. You work for yourself. So then you have to pay both halves of the Social Security tax. It's called self-employment tax. This gets to just one quick tax theory. Under the Internal Revenue Code, known as IRC, there are two types of tax: ordinary income tax, actually three. Let's do them now. Income tax, capital gains tax, which works on gains from stocks and securities and on dividends. And then there's SE tax. SE tax only applies to earned income, and that's what a sole proprietorship is doing. It's earning income. Hence, it pays on your net profit after deductions a self-employment tax. You may also have an income tax to pay on the earnings from the business at the same time. In fact, if you have an SE tax that you have to pay based on your net income, you invariably do have an income tax to pay. Welcome to America. All right, sole proprietorship. The good news is it's good for testing out an idea. Doesn't cost a lot to start, even for the LLC. The bookkeeping is rather simple, and you can run the show yourself. You have no partners to account to. Uh, it doesn't have the highest level of self-employment tax. That's not a great way to say it, but it does have self-employment tax. There's no escaping it as a limited liability company with one member, hence sole proprietorship. You can't escape on your net income paying the self-employment tax. It would have zero liability protection here if you didn't create the LLC, so that's easy to do. And as far as hard to sell the business, I'll just put a couple question marks there. I'm not sure that's the case. You do well enough, you get the great idea, you have a copyright, you got trademark, you got something that you can sell. Uh, Today's world, it's saleable.
I've got a question from the chat. I think it
All
might
right.
even be back a slide, but the question says, please clarify if the self-employment tax applies to profit or revenue.
It's profit and not gross. So it's net profit, which means you take your revenue and you plus it, you subtract your expenses, and you get your net profit.
Thank
Okay?
you.
All right. Good question. That's the way things should be. All right, multi-member LLC is really a partnership for tax purposes. And again, the limited liability company protects all the members, all the owners. Uh, uh, and what's good about it is that you have that liability protection. And here's how it gets taxed. It's what's called a pass-through. That'll be easy to explain in a second. And partners pay tax on their share. And then we're going to come to the last. I'm going to cross it out for a minute as a cliffhanger. We're going to come to the last part of why, when you have a partner, using a multi-member LLC may be advantageous. Okay, so let's explain the pass-through concept of a partnership or a multi-member LLC. Let's see how we want to explain that. All right, let's go back and do it this way. So what happens is when you have this multi-member, we'll call it a regular LLC with multi-members, that's what we'll mean. And what you have like one, two, three partners, let's say. So what you do is you compute the net profit based on gross revenue minus expenses. So you'll have a net profit, net income, we'll call it. You compute that, and that net income, the LLC is not a tax-paying entity, so there's no tax here at the LLC level, but the net income gets divided up amongst the partners and it goes to their returns. They pay the tax. Each partner pays it on their individual return, and that's what we mean by pass-through. We pass through the net profit or the loss and it shows up on the individual return. If there's a loss showing up on the individual return, then it may reduce, that's beyond the scope of our course here today, whether it will or not, but it may reduce the other income, so you'll pay less taxes if you have opening losses from your business. As long as the business is really an active business as opposed to passive, that's the words, but that's a couple weeks of tax courses. But the basic idea is if it's a real business loss, active business loss, then the loss might be able to be used against your other income. Where this comes into play is if you're starting up small with partners, and this applies even to a sole proprietorship if you have a loss. When you're starting up either by yourself or with partners, and you're working while you're starting the business. So let's say you're working for, I don't know, Lockheed Martin, so you're getting a W-2, and then your business entity, the sole proprietorship or the multi-member LLC, we'll call it the business LLC, has some loss, which is not unusual in a startup company, that may reduce the tax on your W-2 income until such time that you no longer are working there, then you wouldn't have the W-2 income to offset it. But any other income you have, that loss could offset it. Just has to be active. And in most cases, your startup businesses that you are doing will be considered active. If you're just an investor, that may be a different story. But meanwhile, these are the advantages when you're starting of using either a sole proprietorship if you don't have partners, and doing a partnership type return if you do have partners, because the pass through means you might be able to use the loss. You will pay tax on income if there is income, and that'll be a net income tax, hence net tax on net income. And you also will probably have a SE tax. When I say possibly have an SE tax, a self-employment tax to pay, if you're active in the business, you're working for the business, you're doing something, then it's going to be considered earned income, just like your sole proprietorship. Think of this partnership, this multi-member LLC, as just a bunch of sole proprietorships put together, filing one information return showing what the net income is, and then dividing it up.
So I think we've got one question here that I think you answered. I just want to make sure it's covered. It's with a specific example.
Yes.
Shandana says, I received some funding from a university startup competition. Our expenses are actually higher than the amount we received. Do we need to treat this funding as taxable income for the LLC? That's part one. And then they say, and if we don't spend it this year and keep it for next year's expenses, is it still taxable this year?
Yeah, so this is so assuming it was paid to an LLC or some kind of partnership, and that's how it was paid to that group, then the group will report it, pass through to each individual, like we see in this diagram. It is on a cash basis, so the day you get the cash is when that's the year it'll be taxable. If you decide not to spend the expenses till next year or pay for expenses, those expenses will be deductible next year. So this year you could have a net income, next year you could have a net loss because of the expenses.
Great. And then, okay, that's all I've got.
Okay, excellent. All right, so this is now one last thing I want to say about this, and then we'll try to move quickly. Uh, is that the beauty of the partnership or multi-member LLC, unlike any other business entity, is here you can see three partners. Well, maybe three partners own one third each. That may be the way you set it up, and that makes sounds like it makes sense. Everybody owns one third, but you don't have to do it that way. It could be one person has 50% and the other two have other percentage. You can set up the ownership any way you wish. But if let's say you set up the ownership as one third, but in the year that you're looking at, let's say partner one did a better job than anybody else, and you want to reward that partner, everybody agrees to reward that partner with more income, you can do that. It's flexible. You can give one partner more income and others less. You can divide it up any way you wish. It's your pie. That's a flexibility that doesn't exist with any other entities. And how you do that would be based on your own group's decision making. All right. Now, moving forward, let's go to the C corporation, which is not necessarily what you want to check the first time out because is basically taxed twice. Let's find out why. It has advantages as well, but it's taxed twice. Here, what happens? The C corporation, uh, is sort of the VC, venture capitalist, choice entity if they are going to get involved in a startup. So you may have to be a C corporation for that reason. But even if it's not, here's what will happen. You're going to pay 20%, 21% on the net income at the corporate tax level. So the C corporation, unlike the limited liability multi-member LLC, this is a taxed entity. It does not pass through to the shareholders. It's a taxed entity. So it pays the tax 21% on the net. Where's the double taxation come in place? When it pays a dividend of the earnings that created the tax at the C corporation level, when that's paid out, that's not deductible, and therefore the shareholders pay tax on the dividends, a lower rate than ordinary income, but the shareholders pay tax on the dividends. There's the two tax result, tax twice. The ultimate end is it's not much different than any other entity where you paying the tax because the rates on the C corporation are lower than individual rates. So it's not necessarily the kiss of death to be taxed twice, but you need to understand how it works. So the C corporation has as its pros and cons. Let's just let me do it myself because I think I can do it where it matters to you. Is that the ownership level that you decide at the beginning will be based on percentage of stock given to each owner. How much stock do you get in the corporation? And that ownership is locked in place until you change stock ownership by selling or exchanging stock amongst yourselves or with the public. And that means that all dividends, all sharing of profit to the shareholders has to be according to that percentage. Unlike that limited liability partnership type concept where you could vary the reward to the individual owners at whim, here you're going to be locked into the percentage ownership based on stock. Not necessarily a bad thing, but that's what it is. And to take money out, you either take money out as that dividend or you take it out as W-2 income or both. In this case, you will have income tax plus the SE tax. In the dividends, you will only have the cap gains tax, which is a lower rate. So there's some advantages that you may find with the um, with the C corporation, but I would only do the C corporation if you're serious about moving towards venture capital or an initial public offering. If you're serious about that's going to happen soon, then I would say that's going to be your entity of choice. Most likely not. And finally, we have the sweet spot, which is the S corporation. The S corporation is the sweet spot because this is a way of reducing SE tax legally, which for me, doing things legally is a little unusual. I'm kidding. Well, maybe not. No, I am kidding. Okay. All right. Let's see how you do that. The S corporation is not like the C corporation. It is not a taxed entity. It passes through its profit and losses, just like the limited liability multi-member LLC did. It's the same thing. You get limited liability protection because it is a corporation. And here's what you do. In order to be an S corporation, you have to make an election. So just be aware that in order to get recognition of an S corporation, you have to make an election. So you probably want maybe an accountant or CPA to be involved just to walk you through that. And then here's how it gets taxed. Like the multi-member LLC, if you have three people, it passes through the net income. And in this case, you can't vary how much goes to each owner. You'll have to file a percentage of stock. You don't have the luxury of the multi-member LLC of varying it from year to year. So it will pass through based on percentage stock. But then here's what happens. The income that's passed through to each individual owner is subject to income tax, but not SE, not the SE tax. Hence, that's why it's the sweet spot, because it's a way of avoiding self-employment tax, or at least self-employment tax on the whole amount of net income being passed through to the owners. However, under the tax law, there's one little wrinkle. Isn't there always a wrinkle under tax law? And here's the wrinkle. The wrinkle is the tax code expects and the IRS expects that if you, one, two, and three, are actually working for the entity, then there would be some salary to pay to you. Again, if one, two, and three are all working, then the expectation is there would be a salary. People don't work for free. Maybe a nonprofit, but even then, if you're working, you get paid. So here's the deal. If one, two, and three are working, they're going to have to get a salary. If only one and two are working, they got to get a salary. Whoever's working has to get a salary. It has to be a reasonable salary. And that salary will be subject to self-employment. Well, it won't be subject to self-employment income, but it will be taxed at the Social Security level and Medicare. And since it's your own business, you're going to pay both halves anyway. So we'll write down SE tax in quotes. So for that amount, you won't escape the self-employment tax because all earned income is subject to Social Security Medicare tax, as opposed to the distribution of profits that we're looking at here, just distribution of profits, not subject to the Social Security Medicare tax, the SC tax. So that's how you can play the game of controlling the amount of self-employment tax you're going to pay. What's a reasonable salary? That's a really good question, and it's based on what other people in your position or make. So it's based on the marketplace. So you would look to the marketplace. What would you expect to earn in a similar job somewhere? And the way we play the game is you look at the marketplace. Let's say if you were doing a similar job for another company, it would be 120 salary. So we'll reduce it to 60 or 75 in order to lessen the amount of Social Security Medicare tax you pay by lowering the salary, but it's still close enough to reasonable that it's like it's close enough. It's close enough. It's going to be depending on what functions you do. We'll look for the lowest common denominator. At this point, a picture like this, the IRS probably wouldn't bother challenging the salary. So let's see, I think I have a slide which will show you here. Let's take a look. This is great. This is some numbers. LLC member and the self-employment tax, 150,000 profit. Their net profit, their net income is 150. They will pay 22,950 in self-employment tax, the 15.3%. So if you do the S corporation and you say, okay, well, let's carve out of that 150, let's carve out 100 as a salary. Certainly reasonable, sounds to me. And then 50,000 of profit just goes directly to the individual like a distribution. Look what happens. You have a savings of 7650 because you didn't have the self-employment tax on the 50,000. That's the idea. This concludes our business entity. By the way, the S corporations have complete liability protection as well. So looks pretty good. And you can be a S corporation with just one owner. You don't need to have multiple owners. It's a pretty interesting way to reduce self-employment tax income if it's an issue.
You've kind of talked about why each of these business entities would work for different types of startups and startups at different stages of the process. And Eric asked, can you start off as an LLC and convert to a C corporation later? And my add-on question to that is, how difficult is that process? Is that something that you recommend? But yeah, what is the process? Do you have to pick
Okay.
the right one from the beginning? If not, how do you go about changing?
Great. And that's the perfect segue. That's where I wanted to go from here. So let's answer that question directly. If you start off and you again do not have venture capital in your immediate future or near future, that's not the type of business you're starting, then you can start safely as a limited liability company, even if you're the only owner. Give yourself the legal liability protection and go for it. Yeah, you're a sole proprietor. If you make income, you're gonna have this SE tax to worry about. But let's see how it goes. Let's see how much income you get. Let's see how much, when it happens and where it happens. And then you'll work closely with the CPA. If self-employment tax becomes the issue, so we'll say SE tax is like strangling you at the neck as you go along, then you would look to a tax advisor to say, all right, maybe it's time to elect to be an S corporation and start fighting the SE tax on its surface. That's a pretty easy change to make. It's just an election. Now, if we do the following, let's erase a little bit here. If we do the following and we say, oh, in the LLC started off and things were going gangbusters, and now we want to be a C corporation because we're talking about some type of a public offering, some type of venture capital, and we want to be a C corporation. It is not difficult to make the transition to a C corporation. In fact, it should not cost, it should be a no taxable event to do so. You will need a lawyer. You're going to need an accountant at that point. You can imagine that. Not selling myself. I'm just saying you will. But it's not wrong to start off as an LLC, add partners later, add shareholders later if you go the SC corporation route or the S corporation route. So I think in my personal opinion is if you're just starting and you're testing the waters, start off as an LLC. It's the safest way and it's very flexible. Okay. All right. Oh, just one question. Even with an LLC or a C corporation or S corporation, be careful not to let the legal world pierce the corporate veil, pierce that veil of limited liability protection. This is not really the tax issue, but it's liability. And what you want to do is don't mix personal and business finances together. Keep separate checkbooks for your personal expenses. Keep a separate checkbook for your business. If you need to pay from your net income, a personal expense, move it from your business to the personal account. That's not necessarily a taxable event if you're a LLC or a S corporation, so there's no big deal there. And just follow the formalities of whatever entity you are. If you're a corporation, do you have to do board minutes in the state that you are, board of directors minutes that is, and just follow it and have it. It's a one piece of paper once a year. If you're an LLC, you can write your own LLC document, and it's easy, a little bit easier than a corporation. These are more legal issues, so I'm going to skip over those. But I just wanted to mention that you want to make sure to follow formalities as you go along. Okay. All right, deep breath here. Any questions because we finished entities at the moment?
The only one I have is, can an S corp have a single member owner? And I'm pretty sure the answer was yes.
It absolutely was yes. That's right. Beautiful. President Biden had, in one of the returns he disclosed, uh, or he may still be disclosing, he had an LLC for his speaking engagements and his royalties from books and things like that. And he was the only owner. And he saved a fortune in self-employment tax. I remember one year seeing on President Biden, I won't write it down, but I remember one year seeing like $10 million in net income. We should all live to have that kind of net income from royalties and speaking engagements. And his salary was 100,000, which left, oh, you can do the math yourself, 909 million, yeah, not subject to any of the Social Security, Medicare taxes. And I think that accountant charged him a bonus fee. Okay. All right. We are on to sales tax. We're going to do
Sorry,
this.
one more came up here.
Go ahead.
Um,
Go
and I
for it.
might ask Jin Woon to clarify. But he says, one member S Corp, then how to do the election?
So it's a piece of paper. I forgot the form number. I think 2553 or something like that. You follow the instructions, you fill it out. You might want a CPA to be overseeing you when you do it, but it's a pretty simple process. You just follow the election, and it's basically when you follow the election, the form has boxes saying what do you want to be. So a lot of people call it check the box. It's a check the box election, and that's all you have to do. Send it in, read the instructions to make sure you have all the formalities in place. Certain people cannot be owners of S corporations. There are some restrictions on who can be an owner of an S corporation, so just make sure you're not violating that. And the limit on owners of S corporation is 100. Nothing could be much easier than checking a box. All right, sales on to sales tax. I'm going to sum this up because I want to get to business deductions. So I'm going to just do an overview on my own on a whiteboard here. The issue with sales tax and state income taxes. I'm going to sum it up rather than go through the details again because I want to get to those business deductions. And here's what the issue is. Today's world, it's hard not to do business in multi-states. You're on the internet. Once you're on the internet, most states look at your activity on the internet. Even if you're in Maryland, selling to Pennsylvania, New York, New Jersey customers, residents of these states, if you're selling there, the way the states look at it now, almost all states, every state's different. When I teach very quickly here, when I teach state and local income tax, everybody in the class learns DOTS. It doesn't mean Department of Transportation Services, but it means depends on the state. So the answers to any state income tax or sales tax question is dots, depends on the state. And here's the point, what I wanted to just alert you to. I can't get you through all the details because there's so many different rules in states and so forth. But if you're in Maryland, you're doing business through the internet, you're selling to residents, even software as a service, you're serving to those residents. You may be subject to income tax on sales made to that state, and you may more importantly, you may be subject to sales tax that you have to collect from your customers in those states, depending on their rules. The reason for this is what they call well, before I give you the what they call, I'm going to give you the illustration. If you drive your car with a Maryland license that you have, you got a Maryland license, you drive your car from Maryland to Virginia. When you enter Virginia, you now have nexus in Virginia, we would call it, because when you're in Virginia, you got to follow their laws. So when you're on the internet doing business and you're in Virginia, you got to follow their laws based on internet sales to their residents. And if their laws require sales tax collections for selling services, software as a service, to their residents, then you have to collect the sales tax on what you sell there. That's what I'm alerting to. You're going to need either an accountant or a company that specializes in advising and consulting with small businesses for sales tax issues. You'll probably need, if you're doing business on the internet and you're crossing state lines and having customers in a variety of states, you're going to watch that. Now, the good news is that as a startup, probably not an issue until you reach 100,000 in sales in any particular state. So when you're just starting off, it's probably not an issue. Maybe it's 200 customers, or it's either and or each state is different as to what they call the threshold of crossing into their line, that nexus issue, where they now have the right to ask you to collect sales tax. And they also may have the right to tax you on your income earned there based on that same nexus. It's called, so you can sound smart with your friends and your accountant if you meet with an accountant, it's called economic nexus. It used to be that Nexus was only like that driving your car example, only if you took your inventory, your business assets, your employees into the other state, then you had Nexus. Now, in the new world with the internet, they have something called economic nexus. Not every state has it, but many, many, many do. And it's almost getting to closer to 100%. And that just means you'll have potentially either or both an obligation to collect sales tax on sales there and an obligation to pay income tax. So that's what you got to be aware of. That's as far as we'll go with this. Any questions? Okay, good,
Sorry,
because I don't.
there's
Go ahead.
yep. Um, if you're selling your product to government agencies in different states, should they collect sales tax, state sales
Oh,
tax?
okay. Probably not because those agencies are not considered residents of the state. So in that case, you probably don't include that in the calculation whether you've crossed the threshold for economic nexus. However, check the state. Every state's different. My experience was I was following that rule about 10, 15 years ago. I was following that rule. We had a client doing business with the government in New Mexico. New Mexico came back and said they had a law different than any other states, and they taxed the client. And they were right. Well, we tried to fight it, but they were right. They won the case. So you just make sure you check uh, each state. Now, New Mexico wasn't just purely internet. They had employees there. It still was the government as the record contractor. So that's why we thought we were exempt. But they had and most states it would have been exempt, but New Mexico apparently has a lot of government agencies there, which is why they changed their law to be different than everybody. But that's a good question. Thank you.
There's a great follow up on this one. It says, early in a startup's life, how much money should we budget for a CPA or tax professional services? If we're pre-revenue and trying to keep down expenses, how far can we get by using the resources on irs.gov? And I think kind of the gist here is like, when do you start needing external? How far can you do this on your own before you need to start spending to get someone else's help on it?
With your own business, you probably need some assistance to file your income tax return every year, annually. But I probably would use as a threshold before I start getting a CPA involved. If I start making more than, let's say, $50,000 of net income. So if I cross 50,000 of net income and I'm looking as if I'm going further, I'm looking as if the chart looks like it's going this way, that's when I would at least consult with a CPA, maybe have a CPA do your annual tax return instead of doing it yourself. Certainly could be less. Certainly could be less because with your own business, the CPA might know tricks. We're going to get to the business expenses next, and you'll see that we might know some things that you don't know. One piece of advice that I could give you, which could keep the budget on the lower side, is I've done it with I've done this with many clients to my own harm, so to speak, because I could have had the clients year by year. But what I actually told the particular startups is use us for a year. Let us show you what the tricks are. And then, unless your income goes way up in the future, in the next year or two, you can do your return on your own. We'll show you how to do it. And so you might want to just talk to somebody who you say, look, I would like to try you out 1 year. You show me how you do it, what the techniques are you're using to save taxes, and then you'll see if things change for the better, more income, then you go back then at some point it becomes worthwhile because you might pay $2,000 for tax advice and a tax return, but you might save 5,000 in taxes. Usually that's how I try to run my business so that the client sees the nature of the savings. All right, on that note, let's go to business deductions. Let's see what the essential rules are. Most people are interested in this because if you're making income, you can reduce the tax on that income, both for self-employment tax and regular income, by reducing it through what are known as deductions. When we play the yay boo game in our tax course, we say, is it yay or boo? So if we say deductions, that gets a big yay. If we say income, well, it's good to make money, but it's from the tax perspective, it's going to pay tax. Okay. So what is the test? Expenses need to be ordinary and necessary to be able to be deducted in a business setting. Personal expenditures are never deductible. That makes sense. Has to be related to the business. Whatever is ordinary and necessary in your industry, what the hell does that? Oh, sorry. What the heck does that mean? And here's
We'll
a
edit
way.
that out in post-production.
Okay, thank you. What the heck does that mean? So the tax court came along and helped us out. These are the words in the tax code, but what does it mean? So the tax court said the following. While there are certain that are disallowed by tax law, if it's not disallowed by tax law directly, the tax court says it's the business owner's judgment, BOJ, business owner's judgment rule. And that it means that if you decide to take a first class flight on a plane to a conference or to meet a client, you're going to spend a lot more than the economy. And so an IRS agent would say, well, that's not ordinary and necessary. You could have taken an economy. No, the tax court has ruled, and it is now uniformly and universally accepted, is that if you decide first class, it's deductible because you made that decision that was what your business needed. So most of the time, the best way to do it is write down everything that you spent to try to make income. That's another good point. Everything that you spend that you believe is in the interest of earning income, building up income, getting better results in your business, getting rid of some expenses. You might buy AI in order to get rid of some other expenses. Whatever you're doing, if you believe it is helping your business, it's most likely deductible unless the tax code says no. An example where the tax code says no is entertainment is currently no. So if it's taking clients to a movie, that's not deductible. Doesn't work. And meals, you got to watch out for most, I think it's still 50%. 50% of the meals spent with clients is 50% deductible. And so you just have to make sure that it is a particular area that is deductible. If you spend medical costs out of your business thinking you need to be in good health in order to run the business, that's nice and it's smart, but medical costs are not normally or not easily deductible. So we'll say sort of not. There is a way to do it through Section 105. We're not going to go there today. And I would tell you all about it if it made sense, but there's pros and cons of doing a Section 105 choice in order to get medical deductions for yourself out of a business because you also have to cover employees it's going to be expensive to set one up. Well, not too expensive, but it's not easy to set up. Again, that's when your business is large. Then you start, and if your family, God forbid, has high medical costs, then that's when you start asking about that. But the basic concept is the business owner's judgment rule. Do I think I need to deduct this? Do I think I need to spend this in order to get business, to do business, to make money? You don't have to be successful. You have to justify that you thought it was. You have to legitimately say, I would be. I was hoping it would work. I thought it would work, but it doesn't have to be successful. I think we all want to be successful with our businesses, but the point is that you won't lose deductions just because the IRS can't say, well, you spent this money for advertising and nothing happened, so I'm not letting you deduct it. It doesn't work that way. You spent money for advertising, you legitimately believed it was going to help, it didn't work. Hey, that's the way the world works. That's the way the universe works. Okay. Certain expenses you deduct immediately, no problem. They reduce your income dollar for dollar in that year. Here you see what they are: salaries, wages, rents, and utilities. Pick up a Schedule C off the internet from irs.gov. It's Schedule C of the 1040, your individual return. That's what the sole proprietor files. It'll list all the expenses on the Schedule C, or almost all the expenses that are deductible. Don't forget, there's the 50% for meals. Don't forget you got travel, which is your car. It usually we go by mileage. There's like a 77 cents, almost 77 cents per mile deduction allowed for your business miles using your car for, again, to give you an example, using your car to go visit a potential client. You will travel 300 miles back and forth. So you got 600 miles at 77 cents a mile to visit this potential client. They don't sign, they don't become a client. Is it deductible? You bet it's deductible. Just document where you went, why you went, what your thoughts were, so that you can use as your fallback to the IRS. Look, here's my diary. This is why I went. I thought they were going to be a customer. I thought they were going to be a client. Yeah, software, insurance, professional fees. At least we're deductible. Okay, I think you get the idea. All right. If you buy equipment, and usually when you buy equipment, it has to be depreciated over its useful life. So that means you can't take a deduction at the year you buy it. However, don't forget about what I just said. If you buy equipment for your business, equipment that lasts greater than a year, like computer equipment, as opposed to office rent, which you deduct immediately anyway. If you buy equipment that has a life of a couple years or many years, it is now fully deductible in the year you buy it. Let's skip that. Skip that. Here we go. It's, well, even better. It's fully deductible in the year you buy it if you wish to, if it makes sense to do that, and create a net operating loss inside your individual return. That's where you might want to use an accountant at least just 5-10 minutes to understand whether it's better for you to do it or not. But if you buy equipment, you can, under bonus depreciation, expense 100% of it in the year you buy it. There's no dollar limit, no income limitation, and automatically implies unless you elect out. So when your software would give you an ability to elect out, you would probably elect out if the loss that it creates can't be used against other income and the loss doesn't carry forward, or it's not carrying forward in the near future. This is probably where you want to get an accountant at least involved a little bit to consult with them to understand what to do. Most of the time, you're not going to be buying equipment that will create a huge net loss right away. So just be careful, because if you elect out, then you get to depreciate it in the future years and reserve that depreciation against future income in the year you buy the equipment. Most of the time you're buying laptops and furniture, and that's usually fine to deduct in the first year that you buy it. It has to be placed in service in the year in order to get the deduction. Can't be used for buildings. There's another way to get great deduction is 179. That's a different story, but it all boils down to the same concept as the bonus. You now have the ability to take a deduction on what is furniture, equipment, trucks. Certain cars don't usually apply to this, although there's some great deductions you can take with cars as well. There's just limitations, but it sort of applies to cars. I just don't want to say it applies to cars right this minute, because that's you have to, again, you got to be careful with it. Um, we'll have to do a separate. It would take a good 20 minutes, a half hour to go through the car deduction, but don't miss out on the auto concept that there's an auto expense. Don't miss out on the possibility of a home office. That's another one. Home office can lead to a deduction, usually not a huge one. So if you miss it, it's not like you're leaving a lot of dollars on the table, but there's a home office expense deduction that you can take under the Internal Revenue Code as well when you are in business for yourself or even as a partner. But that's a little bit different. When you're in business for yourself, you're starting off that you got the home office, you got the auto expense. Don't miss those. Let me just finish the slide deck and then we can open up for questions. Here's the a little bit of a comparison of different timings of if you deduct in a year versus not a year. I think you got the message there. Moving forward, let's see what we got here. Oh, so let's just take a look at some strategic planning here on this slide. Let's take a look. Purchase 300,000 in equipment. Business has 100,000 taxable income. So look what happens. If you take the deduction in, okay, so you take the bonus depreciation of 200,000, you will get a tax savings of 25,000 in year one. See how this is working. All right, I didn't see this slide before. It's pretty cool. All right, so you have 100,000 in taxable income. You buy 300,000 in equipment. Under regular depreciation, the deduction will be 60,000 in year one if it's 5-year equipment. You didn't use bonus. You didn't use the Section 179. So you will at least through the depreciation have saved $15,000 in taxes. If instead you take the 179 on the purchase, 200,000, and you take $200,000, you're going to create a net loss of 200 that'll carry forward in the future against other income, so that goes to the future. And in the year with the 100,000 net income, you will save $25,000 in taxes. Future tax savings will be 50,000 when you have future income. So yeah, so that shows you that the bonus depreciation is great for and the Section 179 can be used effectively even in the year that you don't have enough income to absorb the whole thing. The net operating loss carry forward will be there for you. I know I threw a lot of blood on there, but let's just take a quick look. 300,000 was the deduction. You had only 100,000 because you created a $200,000 loss. We'll put it in parentheses, and you saved 25. So it still works out pretty good. Works out really good. And then you'll save the rest when you use it against future income. All right, cool. All right. The software will do this automatically, so we don't need to do that year end. Um, don't expense capital items. If items have a life greater than a year, and we're not talking about little things like chairs and desks. We're talking about computers and a major amount of furniture that has a life greater than a year. Don't expense it. Do the Section 179 or the bonus depreciation if you want to write it off on that year. That way, the IRS can't come back and say, well, you expense something that shouldn't have been expensed, it should have been capitalized and depreciated over time. And they can't say you don't have the bonus depreciation available to you because you didn't do it at the time. You didn't do it on the original return. Don't claim personal assets as 100% business if they're not. That applies to cars, home office without documentation. So home office should be area cordoned off just for home office use. That you can take as a deduction. Cars need to be, in order to get a really good deduction, cars need to be greater than 50% business use. That works. The phones issue is any one cell phone can be deducted 100%. So if you have one cell phone, even if you only have one cell phone, but yes, your number for business, you can deduct it 100%. The IRS gave up on trying to forge that out into an allocation type method. So the IRS allows 100% of a cell phone, even if it's the only phone you have. Let's see. Don't forget to use the depreciations that write off when they can. And then the most important point on this slide is do good record keeping. The Internal Revenue Code requires books and records. That's what the Internal Revenue Code says. We require books and records. What does that mean? Well, nobody knows, but it means keep some records. Keep records that an IRS agent can look at and follow. Do you want to do it in debits and credits on something like QuickBooks? That's preferable, but you don't have to. A simple Excel spreadsheet where you categorize expenses, show income coming in, to have dates, the amounts of the dates, when things happened. That could work with an IRS agent just as well as QuickBooks. But you need to keep meticulous books of records. And also, I said it before, but most importantly, don't commingle personal expenditures in whatever business entity you're using, even if it's just a sole proprietorship. Have a separate account for that. Have all the expenses in there only be for the business expenses. If you need to pay from a personal checkbook an expense for personal reasons, move the money as a distribution to your personal account and pay it from the personal account. So it becomes clean. You can, IRS agent, even you or a CPA can see in that account what was the business expenses for the year. They can just, see the whole thing is only related to the business. Wow. We People still alive?
I know for a fact that this is in the top 5% of my experiences with taxes. So it might be a low bar to clear, but I thank you very much. It was fun, interesting, educational. I've got a couple questions in here if we have time. RK actually
Absolutely.
asked a question that I want. This is for if we have time. We'd love to hear about some fraud investigation stories that we could learn from. I know you teach a really cool class on that. But before we get there, let's see. Yeah, I think these two actually go together. There was one question on kind of the specifics you were talking about with deductions and depreciation and bonus depreciation. The question is, so can you deduct the entire cost in year one and also take the regular and bonus depreciations? Question mark, confused. But in the chat, someone else, is it recommended to hire a CPA to handle all these details? And I guess my kind of overarching question for both of those, if you're looking at like a significant depreciation that you're trying to figure out what years to take in, is that an example of the point in time in which you should already be consulting with a CPA or working with an accountant and not doing that on your own? Or is this the type of stuff that you should still be maybe potentially handling on your own as you're still in the pre-revenue stage?
If you have enough revenue where taking a deduction like we saw in that little example makes sense to do because you have 100,000 net income and you got $300,000 of equipment that you bought, you need a CPA.
Yeah.
It's
So
plain,
yeah.
yeah.
So if you're confused by this, again, the answer is yes, make sure you're consulting with somebody who isn't confused by this before you're trying to do it on your own.
The good news or the type of news that's important with this kind of overview is to understand some of the language that they're going to be throwing at you so that you don't go in blindfolded and then come out dizzy. That's the idea. And one last thing to mention before the other question that you had is that there are retirement programs that you can get into to help reduce net income in a business that you would want a CPA or at least somebody in the pension business to help you walk through. But that's like the IRAs, but it allows you to put more money than the IRA, the individual retirement account. And again, you need net income to be able to do those plans. But that's once you get rolling and you're starting to make money, that's another great significant deduction, totally legal. And some plans allow you to put in a heck of a lot of money.
Awesome.
And what was the other question
If there
about the
are,
fraud?
oh yes, before the fraud one, I actually combined two questions together, but somebody did ask earlier, and I said I would get to it at the end. Um, let's see. Enzo asked, when starting an LLC, do you have to file taxes quarterly, or can you get away with doing it once a year?
Oh, all these entities we spoke about are just filing once a year. You may personally have to file taxes on or pay taxes on a quarterly basis. That's something, again, at that point, you're going to want to have a CPA help you or a payroll company help you decide how to do that. But it's the all the entities are just once a year filings.
Okay, great. Then yeah, if other people have questions, feel free to put them in. They haven't, let's see. Oh, this I think is a good one, based on your last response. Do you have any recommendations on how to shop around for a CPA? What questions should we ask before hiring them?
Oh, well, that's a really tough question to answer in a certain sense because my experience, all the years I've been there, is that most of our work comes by referral, which means the person calling us heard from one of our clients, hey, they're okay, they're good, they did good by me. And so that's how people seem to decide more often, somewhat like doctors, but I think that trusted advisor part of our profession has led it to be more by word of mouth. And so you want to talk to other business owners. Certainly, you can go to Maryland's site of their CPAs that under the Maryland Association or the Maryland governor, the government's Maryland Association that takes care of licensing. You could get names that way, but I think that word of mouth is probably should be what you do. Again, you usually are in some type of industry association with people doing what you're doing, or you talk to other colleagues, competitors, so to speak. Um, that's the way I would work it.
Yeah, and I'll piggyback on that. At Ventures, since we are part of the University of Maryland and we're a state entity, we're not allowed to actually refer people to anywhere. We're not allowed to give preferential treatment to any clients, but we do ask the companies that come through Ventures who they work with for legal or for CPAs. And so if you are working with University IP, if you are part of the Ventures ecosystem, and you're working with an innovation manager, reach out to them. If you know Ala or me, reach out to either of us, and we can share with you the list of CPAs. Again, we collect, again, lists on all different types of people that the companies that are part of the Ventures ecosystem work with. Again, not a recommendation, not us saying go talk to these people, but just us saying these are who our companies work with, and then you can reach out to the company and ask, hey, how was your experience working with the CPA, and kind of using that referral to find out who to work with. All right, we're 3 minutes over the hour, so if you do want to share a quick story of a fraud investigation story to learn from, if you have one off the top of your head, but if not, again, thank you so much. This was great, and again, way more fun than I think I expected to have with taxes on a afternoon in February.
Okay, well, thank you. Sharing a story, man. I have so many, and it's hard to I want to go from one part of my brain from tax to fraud. But I'll share the tax fraud cases, tax evasion cases. I'll share that. If you're not in the class, this will be a little news to you. That is that tax evaders are doing it with intent as part of what makes fraud a crime. You're doing it with intent. It's not that you didn't know the law. You can still get in trouble for not knowing the law. It's no excuse, but fraud is usually defined by I intended to steal. So people who are charged, and I've had clients who are charged with tax evasion, the IRS and the Department of Justice, they have to prove that there was intent in the tax maneuvers that the person did, helping reduce their taxes and save taxes. Oftentimes, the intent is just shown by the fact that they didn't file a tax return for 10 years. I've had that. So I have some people, at least once a year, somebody comes in, I haven't filed in 5, 10, 15 years. That's a red flag and with big waves because the IRS just loves seeing that kind of case because not filing is almost an admission of trying to avoid paying taxes, hence tax evasion. So we had one client, my first tax evasion client had not filed in 10 years, and I had to defend him to keep him out of jail. That was what he was paying me for. He said, whatever you do, keep me out of jail. So I said to him, well, they have to prove intent. So we have to prove that you didn't intend to evade taxes. So I guess that means you have to pretend to be an idiot. That was my advice to him. And it worked.
Great. Great, great. Well, thank you. We will encourage all of our attendees here, don't pretend to be an idiot. Don't be an idiot. You wouldn't be an idiot. Again, like Professor Handwerger said, this is great information for you to take into the context of if you're really early stage, knowing what's coming down the road, to take into the context of how do you talk with a CPA and about taxes. But at a certain point, like it's always worthwhile to actually get that professional help and advice. And like Dr. Handwerger said, you can actually save money by doing so, and often will. The questions coming in now are all thank yous. Thank you. This is very helpful. And so sharing my appreciation.
Josh, if I can have the last word, it would be the following.
Go for it.
Having been a career CPA, watching small businesses come in and new clients as they start off, I am in awe of all of you and what you're venturing out to do in life, in your career. It's a extremely great thing to do. It can be very satisfying. I personally don't have the risk tolerance for it, but that's why I'm in all of your abilities to do that. And my power goes to you, and my wishing of best of luck to all of you.
Great. Thank you. And I think we'll have a follow-up conversation to this on Thursday, right?
Yeah, we go to tax credits, which will be really geared to people who are looking to get into the businesses that allow for credits so that you can use the credits for what they're designed for, and that is to find investors to help build the business. So they're for certain types of businesses. Real estate is certainly one of them. Some and businesses in particular zones within the community that are demographically challenged. So those are the things we'll be talking about on Thursday.
Great, great. So we hope to see you all on Thursday for continuing to have fun with taxes. Thanks, everybody.
Fun with taxes.
All right. Talk to you later.
Thank you. Thanks, Josh.